All right, everyone. Welcome to the stream. Welcome to the show, D-Financial Friday. Got another exciting show for you guys today and a bunch of different topics that we're going to discuss, review the big question that we got this week and tie that into our show. But before we do that, Raymond from Diversified Capital. We're both from Diversified Capital. But Raymond, how are you doing today?
Doing good. It's another week gone by. It's Friday again. I'm looking forward to the weekend again. How about you?
It's a long week to say the least, I think, for everybody. Hopefully, if you're joining us, take a deep breath here and kind of think about the week that we've been through. It's been a long week. Of course, I first saw him with the election. We still don't know what's going on. We'll talk about that, how that affects the markets, how that has changed some projections going forward. So we got all of that for you. Now, special thing this week, we got a guest joining us. We got Nikki James from Flagstar Bank joining us a little later in the show. The biggest question that we've gotten all week from financial planning has been about mortgages still, whether it's about refinancing, whether it's about where rates are today. There's some confusion about this new fee that might be tacked on by the end of the year for refinancing. So Nikki's going to help us clarify all of that. But of course, with any of our D-Financial shows, we're going to start off, and what a week to start off by talking about what's gone on in the market. Okay, so we're going to give you a little bit of a recap, and tell you about some of the things that we're thinking about. Before we do that, of course, our disclosures, right? Anything that we talk about on the show right now, or on any of our shows and streams, right, is not meant to be for personal financial planning or personal financial advice. This is for you guys to absorb as education and just learning a little bit more. Okay. And from Diversified Capital, when we talk about anything tax related or investment related, we're not soliciting for you to buy any sorts of investments, right? And for a tax perspective, we're just talking again from a generalized education perspective. The strategy portion, always go to your tax professional. And again, from us, hopefully just asking the right questions. All right. So what a week. Yeah. I think for us, it's been a little bit of a wild ride. We're going to show a little bit of a ticker at the bottom here. Best week since April, Raymond. What's going on? What are we seeing right now?
Yeah, definitely. I mean, I think the most thing that's been kind of looming around everyone is just the elections, right? What we've been seeing with the elections since Tuesday. It's been pretty nerve-wracking, to say the least, in terms of what's been going on, but it's still too early, right, to count. There's still a couple of states here that are still remaining, but currently it seems like Biden is in the lead. So hoping to see what's going to happen next. I think there's going to be a little bit more final news tonight, but from the elections itself, I mean, what we saw within the markets really has been because of some certainty around Congress, right? So as of right now, it's the Democrats with the House and then Republicans with the Senate. So it has that split Congress now, which is actually good news for the market. Historically, the market has done well during the split Congress here. But what we saw within the market is because with this split, it's going to be a lot harder for just legislation to pass, right? Things aren't going to get done as easily if it was all Democratic or all Republican. But with that split, with at least with a lot of tech companies where we've seen a lot of growth or gains this week is going to be because there won't be an increase in taxes, or there's likelihood that there wouldn't be an increase in taxes, at least for the next couple of years, which is what drove the market and primarily tech stocks that we've been seeing. So from this ticker symbol here, you can see that the S&P 500 was up 7.3%. We have the NASDAQ at 9% and the Dow Jones at 6.9%, right? So
and that's this week. That's not exactly. The year. Like I mean, if we had that for the year, Raymond, that's a pretty dang good year. Right? You're just talking about this week alone. Mm-hmm. Yeah. I mean, and the crazy part is, right, like we talked about in last week's show that the uncertainty around the election, I mentioned the process of the election is going to cause like market volatility. Look, volatility happens both ways. Now, did I expect it to go up this much? No, absolutely not. And we'll talk next week. Like, why? Like, how do you actually navigate things like this? And I'll highlight this at the end of the show. Like, how do you actually navigate the idea of when big events happen like this? Do we invest now? Do we invest later? So we're going to give you thoughts about isolating some of that noise, right? That's for next week's show. But for this week, just thinking about the idea of, right, the process itself right now, it's still uncertain. I think we're getting more clarity,
Right.
like Raymond said, and the market does things like pricing in what they think. They price in what the next 6 months potentially is going to look like. So right now, they're pricing in that maybe little to no regulatory changes as well, right, Raymond, around like the big tech firms, right? If you remember, Apple, Google, Amazon, all the CEOs was up on Capitol Hill talking to Congress about what it meant for certain how they conduct business, right? Are there antitrust violations? The thought is if we have a split government, some of those may fall to the wayside and that isn't a primary focus anymore. Well, if that's the case, that's why they've surged right now. Particularly some of the other stocks like Uber and Lyft. Those guys got a huge bump this week. Why? Well, specifically in California, Proposition 22 passed, allowing them to specify a separate class of employees, right? And that has allowed them, I mean, they pushed, I mean, by the way, Prop 22 was the best funded bill of all time in California when it comes to trying to lobby for it. They got it to pass. And now they're going to be in a position to potentially plan their business a little bit better, right? There's less uncertainty about that proposition. They went up. So as you can hear me talk about the markets, sometimes it's about that uncertainty. Removing uncertainty makes it that the markets are going to do better. Right now, I'm not saying that there's no uncertainty. There's still a ton, but I think there's a little bit more clarity that, for example, there wasn't some blue wave that swept over everything. And now the Democrats are going to be able to impose all the different things that we talked about. From a market standpoint, I think that would have been tough. Right now, they're projecting that split, that stagnation in our government, and thus you have some increases in the market. Not just some, best week since April, right? The other thing, Raymond, we saw healthcare stocks jump quite a bit. And I think it's the same thing, right? That there's been talk about like pharmaceutical regulations, right? Pharmaceutical prices, drug prices. Again, that may also be falling to the wayside. We saw some like United Healthcare, some of these stocks just jump dramatically. Okay. And so from our perspective right now, all we're saying is the market is thinking that things aren't going to change as quickly as maybe even the Democrats have hoped or one party would have hoped. If it's split, right, things are going to remain more static, and thus it could be good for the market.
Yeah.
Okay.
Definitely. And I mean, we're not necessarily out of the woods yet, right? There's still,
Sure.
With the elections, that was one of the items that we mentioned last week in terms of the market uncertainty. So that's kind of just checking one other item off the box. But I would imagine with the elections, that there's still probably going to be some type of recount that Trump might request for, depending on how close these votes are. And it's looking like that, right? These last 3 to 4 states are super close to each other in terms of the votes. So we'll just need to see how that goes. So, what a good week that we saw this past week, but not necessarily out of the woods. I mean, there's still the coronavirus, right? That's still there that maybe people might have forgotten about.
The coronavirus. I like how you said that, Raymond. It's still there. Yes.
Yeah.
We're all still being affected by
Exactly.
it. What was it? 20% jump in cases?
Yeah, I think we read somewhere that there was a 20% jump in cases, and there was a record of 121,000 in a single day.
Yeah.
Jeez.
I mean, I feel like in March and April, when that was the case, when we were looking at 7-day moving averages, when the moving average was headed up, the market was trended down. When the 7-day average was trending down, the markets were moving up. At this point, maybe again, people just put focus. The market puts focus on different things. Coronavirus, maybe not right up against the focus at the moment, but it will come back, right? People will focus on different things. And I think that number is going to affect how we look, especially headed into winter, especially headed into a condition maybe that the coronavirus does thrive a little bit more. We have to be very careful. And so, ultimately, there's a concern still, that backdrop of volatility, but at least right now, the market seems to have, ignored some of that. And again, not all smoke and mirrors, right? Corporate earnings, we talked about last meeting, is still doing well. Companies have learned to cut cost. If you're spending less, revenue stays the same, you still make more money, right? And so I think that's what you're seeing right now in companies as they're projecting their earnings. Now, I'm going to touch upon one more thing before we jump into Nikki and bringing Nikki onto the show here, talking about the mortgage, which is bond yields. Now, we always talk about stock markets. it's the fun thing, right? That rises, it goes down. But bonds actually are a very important indicator, also a very important part of the market. Bonds, it's like debt, right? Think about it as whether it's you're borrowing money from someone and paying interest, the other person actually owns that bond, or the other way around, where you're investing in bonds, it means that you're lending somebody money and collecting interest. That's how bonds work. Well, bonds can be issued by companies, it could be issued by governments. If you look at the Treasury, which is bonds issued by governments, right? We're talking about bond yields. That generally can be a good indication of what people are thinking long term. So stock markets, right? You see again at the bottom that it's gone up, but right after the election, bond yields actually dipped dramatically. I think there was a concern there that, with how the election was going, that we would see maybe some long-term decline in growth. But I don't think that's decided yet because it's fluctuated a little bit more last a day here as Biden has edged a little bit more of the lead, right? The actual bond yields have actually come back up a little bit. And that's where I'm going to bring Nikki on in just a second here to talk about rates themselves, because bond yields, maybe not sometimes a direct influence, but it does drive where the interest rates are, okay? So maybe in a future show, I'll talk a little bit more about bonds, because I certainly think that it's a little bit more misunderstood in the market. But guess what? This year, bonds are still up a decent amount. Bonds have stabilized a lot of our clients' portfolios, and bonds serve as a way to balance out a portfolio, that you don't always have to have the aggressive allocation. And again, I'll tie that in maybe like next week, thinking about best ways to invest in this environment. All right. Going to bring Nikki on now. We're going to talk a little bit more financial planning. We're going to talk about mortgages. Nikki, how are you doing? Happy Friday.
I'm great, thank you. Happy Friday to you. It is very Friday.
It is very Friday. I think we are all ready to be getting a cocktail here and there.
Yeah.
Definitely fried.
Yeah, absolutely. Well, thank you so much for joining us. We love having you on.
Thank you.
As our viewers have seen, Nikki's been on a lot of our different webinars, answering different questions. So bringing on her onto D Financial Fridays for the first time here, and actually our first guest on D Financial Friday, right? So we're excited to have you.
Thank you.
Talk about mortgage rates, right? We're going to talk about mortgage questions. Give us a little sense right now, Nikki. What are you seeing maybe headed into the election, but now have there been fluctuation in rates? Like, what are you seeing on your side?
Sure. Yeah, I mean, there have been, but they're not tremendous. So we definitely saw some tightening before the election. We saw rates pop up a little bit. It's not that material. It's maybe 1/8 of a point, maybe a quarter on some particular products or some profiles, but it's really been a great time and continues to be. So yes, after the election Wednesday, we saw rates go down. So, sitting in the high twos. I have a hard time saying a 2 in front of an interest rate, but
For sure.
I mean, it's just like it is. They're in the high twos, so 2 3/4 on most loans. What's interesting is we're really not seeing as huge of a difference between jumbo and conforming. So jumbo loans are anything that's above, in our area, 765. Those are loans that don't conform to Fannie and Freddie's rules. And it used to be that we had a much bigger spread between those two. And was pricing a few purchases today, and whether you were conforming or it just didn't matter. And even that, we used to have a distinction between, so nationally it's 510 is the conforming limit. And there used to be quite a big distinction from 510 to the 765, which is what we call high balance conforming. It's just for high cost areas, which we fall into. And it's kind of flattened across the board, which is, the first time I've really seen it that flat. Right after COVID hit and we had some tightening, the high balance, because it's unique to our area, really bumped. And those in some cases were higher than jumbo, which is the above 765. So it's just been interesting how they've kind of played around. And now we're just kind of at a flat sort of 2 3/4, 2 7/8. Obviously that's for the high profile of credit score, down payment, all of that good fun stuff. But
that's a perfect segue right there. Like you talked about like profile and qualifications. Has that changed? I mean, I know that like COVID in March, right? Like we had a lot of clients, especially, and we don't have to get into the details about like self-employment and 1099, but just in general, I knew that the qualification remarks and requirements changed a little bit. How has that changed throughout the last 6 months or so, headed into November now? What are you seeing in terms of difficulty for qualifying for mortgage? Is it harder? Is it easier? What are you seeing?
Yeah, great question. It's sort of like interest rates. They'll spike and then trickle down. Well, the same with the guidelines. As soon as COVID hit, we're like, oh my gosh, sky's falling. Okay, we can't do this, we can't do that. So we took away a lot of the higher loan to value things. We were concerned about credit scores. If we were seeing people who are, especially if we have any forbearances, that's where you actually call the lender and put your payments on hold, which was a thing that was allowed, except it didn't help you in the credit, because we won't do the loan if you've done that. So it sort of definitely fell off a cliff a little bit initially, and now we're seeing it trickle back. So just this week, we brought back our equity lines to a 90% combined loan to value. And what that means is that we're willing to accept risk on the values of homes. So we're not frightened that the market's falling out of values, because we're allowing a 10% equity position when we're in second position, which is the most risky position you can be in. We're seeing non-owner occupied loans coming back. Those are always the ones that go away first, because if you're going to foreclose on anything, you're going to keep your house over your head and you're going to let the investment property go. So those ones tightened up. Second homes tightened up. So it's slowly coming back. Each week we get a little, we've got this again, and we've got that again. So it's definitely headed in the right direction. I think we've just kind of got used to this new normal. I think it's going to be here for a while, and we've okay. Especially, so these rules aren't specific to our area. They are nationwide rules, Fannie, Freddie, nationwide things. So, and the jumbo market too. But we're definitely, I think, as an industry, figuring that people can work from home, that they can continue to have a job and they can continue to make their payments. And so we're saying, okay, it's not good. We don't like it, but,
But people still need to borrow. Right.
Yeah.
More so, actually, because now they're figuring out the houses don't work for them, because they've got the kid, and I can't tell you how many people I talk to whose office is in their closet.
Yeah, my office is in my bedroom. You just can't tell right now in the show, right? And so if I put my camera out, it's a whole different ball game, right? And so, but and I think that goes to the point where it's good to hear that lending is still happening. It's not like you can't get a loan. Of course, you still need the right qualifications. I think you talked about a little bit to me before the meeting about bridge loans. And we've covered this before in a separate webinar, right? But you're seeing a lot of that right now too?
Tremendous amount of it. It's one of our most popular products. People don't want to have to go out and sell their house, then move into a rental, because in our area, you can't sell a house while you're living in it, especially in COVID. But in before, we're pretty picky. We want to walk into a house that's nicely staged. We don't want to see people's clutter around. And so you have to move out, get it staged and look pretty. And in COVID, you don't want to walk into somebody else's house or have people come into your house. So it's even more important that you can move. And so people don't want to have to move into a rental or move in with parents who are worried that they've got the grandkids with them and they're going to get COVID. So it's really changed things. So it basically, what a bridge loan does is it enables you to release some of that equity to put down on the new house, so that you can then move into the new house before you've sold the old house, move into the new house, do all the fun stuff and the fix up on the old house, and then sell it and then restructure the loan. So it's been a very popular product.
I actually had a question come in, and I wanted to bring it up to you. Does, you talk about qualifications, and someone just asked me, does co-borrowing affect mortgage rates? Is it any different if it's a husband and wife borrowing versus daughter and parents borrowing, right? Is there any difference in that from that perspective? And then follow-up question to that would be having that loan versus how they're titled on the actual home, needing both of them on title, or does only one of them need to be on title? I actually get that titling question a lot, but maybe the first part, does the co-borrowing affect rates?
Great question. And generally, if you're all occupying, we don't care. So you can have a multi-generational, families all occupying, doesn't matter. You don't have to be married. We're not picky, nothing. There's no judgment there, as everybody just goes into the pot. Where it gets a little trickier is if you have a non-occupant co-borrower, which where a parent's helping a kid, or we have it the other way around where a kid's helping a parent, or, I have actually a set of cousins who are buying together. So when it's a non-occupant co-borrower, there are different rules with certain loans. So in the jumbo market, generally, a non-occupant co-borrower doesn't really help you because the occupant's debt-to-income ratio still has to fit our rules, still has to fit guidelines. But we do have some options. We have a couple that came out, I don't know, 6 to 8 months ago, and they didn't go away with COVID, which I was really happy to see, where we blend ratios. What that means is we just put you all in the pot, even if one of you's not living, and we just say, this is the debt-to-income rate. And of course, we have to use whatever. So let's say it's mom and dad helping out the kids. We have to count mom and dad's debt on wherever they're living as well. But as long as there's enough income in the whole transaction to qualify, then no, it's absolutely possible to do it. So that parent-child thing is a more unique loan. You won't find it with every investor, but we do have it out there. So it's certainly possible.
And in that situation where it's one person's living, one person's not living in the home, do both of them need to be on title because both own are part of the loan, or does one of them need to be on title?
So as a general rule, yes, they both need to be on title, because if we want to foreclose, you can't indebt something that you don't own. So if they're not, but it has changed. We do have a couple of options where it's not common, but there are a couple of options where you don't have to be on title. You can be a debt only borrower.
I see.
But it's less common. It's more common that we want you to be. And in that case, you would hold title. There's different ways. Obviously, I mean, we can do a whole webinar on how to hold title, but normally you'll hold it as tenants in common.
Got it.
And a lot of people get really confused with tenants in common here because they're like, oh, tenants in common, I've heard of those in the city. Those are those properties that you buy as a TIC. That's different. That's ownership to the house. So, and that's a completely different funding. You can't get conventional finance with a TIC in the city. But what we're talking about is how you and mom hold title. So maybe mom and dad have a trust and you're the kid. So it's the trust holding title in tenants in common with the kid. And then you can split it 50-50, 60-40, however you want.
Yeah. Yeah. And so it sounds like there are options out there, right? To make that work. And again, but not everybody. And you know what? Even what you've talked about in terms of lending regulations, I've seen through COVID time, certain banks are much more conservative than others, right? We've run into situations where one bank wouldn't do it, but another would, right? And so I think that's something that you guys just our viewers have to be aware of, that what we're talking about is just general trends that we are seeing right now. I did want to get to the main question though, why are we talking about mortgages right now? Because I got a ton of questions over the past week about people wanting to rush in to get their refinances done because they heard of some fee that was going to get applied by the end of the year. I think there's a misunderstanding of this, right? And Nikki, share a little bit about what this fee is, what it's called, and how should we best think about that fee?
Yeah, so it's called the adverse market fee. It's 0.5 point on any loan up to either the 510 nationally or the 765 locally. It's already priced in, which is probably why we're seeing less distinction in the refis between conforming and jumbo, because that's priced in. It's also not 0.5 point in rate. It's 0.5 point in fee. So what that means is that's the discount point. So normally 0.5 point will maybe get you 1/8 lower in rate. Probably not even, actually. It depends on any given day. It's anywhere from 3/8 to 3/4 is kind of what you'll get. If you put that up front, you'll get a lower rate. So right now you're being charged that. So essentially what I'm saying is if we took that out of the conforming market, you'd probably see those rates 1/8 lower.
I
see. It's already in. And it's already in because these are loans we're delivering to the market. When we lock a loan today, we have a delivery we probably lock it for 60 days, and then we have probably a 30-day delivery pad behind that because it takes us a while to get it all packaged up and sold to the secondary market. So this came in a while ago. Now, it was interesting because it came in back when they did it originally. I forget what it was, like June or something. So we put it in right away, and then they extended it. And then they said, okay, no, sorry, we won't do it. We'll punt it until December. So it's now being punted and it's not clear if it'll actually stick. So what happened for the people who locked back in June when it was already in there, priced in, and it never ended up happening, is we went back and we gave people lower rates. So we were able to lower their rate.
But you're saying it's actually in already. It's already, if you're getting quoted for a loan and it's 2.875, right? That's already priced into the price itself.
it's already priced in. And you will see some lenders who will say, oh, we don't have it in there. But if you actually look at the bottom line of rates, it's priced in. It's sort of like when people say, oh, I've got a no-cost loan. Well, there is no such thing. We still have to send an appraiser out. The escrow company still has to do their job. It's just, it's in there somewhere. It's, you know.
Got it. I think that helps a lot of people that, probably between Raymond and I, just seeing clients asking us right now, I'd be like, well, if you're getting quoted a rate, the rate is already part of that usually, and it's already priced in. If you like the rate, right? If we talk about that rate makes sense, you won't have to worry about that cost because it's already in there.
Yeah, don't try and time it. Just don't worry about that. There are so many, we call them loan level pricing adjustments, LLPAs. There's all sorts of stuff in there. So if you actually looked at a loan that gets priced, it's like, what's your credit score? What's the loan to value? There's many things that go in line items, and it's just one of the things in there. You never see that as a client. You just get the rate. So I would just focus on the rate. If you're happy with the rate, forget that.
I like it. Keep it simple. That's always our idea, right? Like if you look at it today, right, don't worry about where it's going to go, which again, will tie into us talking about investments next week. But again, those are all the questions I had, Nikki. Thank you so much for joining us. Thank you so much for
always. I love joining you guys.
Yeah, it's awesome for us to have you on. Our clients can hear directly from the professionals about what the mortgage side looks like. But again, thank you for joining us. Hope you have a good Friday. Hope you can go get your martini now and enjoy yourself.
Yeah, a few emails to get through before that, but it's the carrot is out there. So thanks for having me on, guys. Lovely to see you all.
Awesome. Thank you. All right. Well, again, thank you to Nikki for joining us, helping us answer some questions around mortgages. And you know what? This is what we're going to do, right? We're going to be summarizing a bunch of the questions that we get over the week from a financial planning perspective and sharing it with you. And I already know what the next week's show is already going to be, right? We've gotten so many questions this week around investing. I think people are just confused, Raymond, about, this year has been difficult, okay? But like if you difficult in many ways, but if you think about the investing side, how do you know, right? How do you know when the right time is? If I'm thinking about timing, if I'm looking at market, nothing seems to make sense. When do I start to invest? And that's what we're going to touch upon next week, right? We're going to touch upon this next week about in a situation where you have an environment like this, how do I manage my investments? How do I manage getting into the market? Do I get out of the market? Should I be fearful? I'm going to touch upon all of that. I'm going to also give us an idea, some thoughts from, of course, one of our all-time famous investors, Warren Buffett. I was been listening to a little bit of podcasts, and he brought up some really good points about thinking about your investment decisions. And so I'll tie that into next week. It's also going to be, as crazy as it sounds, almost the end of the year.
Yeah.
And for me, tax-wise is going to be a big thing for clients, right? And so I think we're going to try to tie in a little bit of what Raymond and I think about in terms of discussing with clients, key pieces to watch out for. Are there ways to project your taxes? And so just a little bit of tax education and tax questions that you might want to be asking yourselves before we head towards the end of the year here.
Yeah. Pretty exciting topics for next week. I feel like it's very common questions that we get around investments and taxes. So we'll be addressing that next week. Feel free to comment, within our pages as well on Facebook. If there's any topics that you as a listener want to hear about as well, or have us discuss. So feel free to add any comments in there.
Yeah. And for those of you wondering, I know that if you've been following us for a little bit, Nathan is usually on our show as well. Nathan, one of our other partners at Diversified Capital. He's taking a little bit of a leave for family reasons. If you're watching, Nathan, we're thinking about you, and we hope to have you back on the show soon. But in the meantime, we got Raymond and myself holding down the fort, and excited to have you guys continue to join us on DFinancial Fridays.
Thank you, everyone.
All right. Thank you, everyone. Have a great Friday, and we'll talk soon.
All right.
Bye.
Bye.